I'd like to start with a quick show of hands. So can you put your hand up if you know your bank manager's name? That's very easy then. So I'm pretty sure you can't explain standard variable rate mortgages. Anyone? Oh, one. You're very brave. You're a unicorn, in fact. My point is that financial services are confusing, inaccessible, and cumbersome, but we all rely on them every single day. Now, I'm pretty sure, given a choice like this, you could probably come up with a sensible decision. But how about now? Not so easy, is it? So who am I, and why am I comparing wheelbarrows and credit cards? Well, this is me. And from a young age, I've loved making things. Now, at first, this meant sticking everything together with sellotape. But I quickly discovered computers and built my first website when I was 11. Shortly after graduating, I moved to San Francisco to work for an early-stage tech startup. I love making software. And software's everywhere, be it your phone, your washing machine, and your bank. And if banks are just software, then I realized that's something I can make too. Last year, I moved back to London and applied for a credit card to fund my entrepreneurship, or unemployment, as my mum called it. I was rejected. It turns out, after living outside of the country for 2 years, I had a terrible credit score. And I'm not the only one. Thousands of people get rejected for credit every single day for a whole raft of reasons that are outside of their control. So I founded a FinTech company. Now, FinTech is short for financial technology and is an area that has grabbed swathes of investment and many headlines of pink broadsheets in the past couple of years. And now I spend my time hanging out with these guys. But so much of the attention in FinTech has focused on building complicated wealth management products designed to answer questions like, how can I optimize my investment portfolio, or how can I consolidate insurance to save money? In fact, our industry has even come up with an acronym to describe our most lucrative target market. We call them HENRYs, and HENRY stands for high earning but not rich yet. But there are 13 million people in the UK that don't have enough savings to survive losing even a quarter of their income. And worse still, we're busy closing the services these people rely on the most. Just this year, we've seen thousands of bank branches close their doors and can expect more of the same cost-cutting in the coming years. But there's a huge opportunity to use technology to help these people. So back to credit scoring. This is Leon. Leon's applying for a loan. His application gets passed to a credit bureau to answer a very simple question. Is he going to repay or not? The problem is, the information that's used to answer that question is incomplete at best, but grossly irrelevant for a huge number of us. And the reason is, the bureaus themselves refuse to involve the end user in the process. I mean, after all, if you want to know about me, then why don't you just ask? It's a bit like me writing your CV for you, even though we've only just met. And the weird thing is, the credit industry themselves actually sees this as a good thing. I remember being in a meeting once, sort of early on when we'd started the company, and someone said to us, well, if our customers understand their credit scores, then they'll game the system. And I didn't say anything at the time, but I wanted to say, well, if your credit scores are any good, then gaming the system would mean your customers become financially healthy, so great, game on. And what's even weirder is the lending companies, in the absence of good data from the credit bureaus, have started coming up with their own methods of evaluation, each more weird and wonderful than the last. I remember another meeting, someone talked about a street check process, which I assumed was some kind of sort of way of verifying address or where someone lived. And it only turned out later what they were actually doing was getting in their cars, driving past people's houses and checking if they'd mown the lawn or taken the bins out that week. And I'm sure you've all used websites like this, or at least seen them. Pick how much you want to borrow and for how long. But did you know, as you move those sliders along, these companies are actually measuring how you behave and using that to decide if you're creditworthy? And did you also know that they'll change the initial positions when you load up the site based on where you live to try and convince you to borrow more? So it's pretty obvious that technology can be a force for evil in financial services. And at this point, the idea of turning your bank into a robot is probably conjuring up some pretty scary images. So let me use the rest of my time to try and convince you that technology can be the key to building a fair and inclusive financial system, and one that works for everyone. A recent study found that over 50% of us still want a face-to-face relationship with our bank. And what's more, a third of us actively distrust banks that don't have a high street presence, even if mainly banking online. So the question is, how can we have a face-to-face relationship with our banks if they're robots? Well, NLP stands for Natural Language Processing and is the field of computer science, artificial intelligence, and computational linguistics concerned with building interfaces between computers and natural language. Or put more simply, converting written and spoken words into concepts a computer can understand and manipulate. Now, I'm sure you've all used tools like Apple Siri, or maybe like Google Now, set a timer, check the weather. Well, later this year, RBS are going to launch their Luvo chatbot, which is powered by IBM Watson. Now, at first, this is just going to help direct customers to the right departments. But over time, as the algorithms learn, it will be capable of much more complicated tasks. Imagine, for example, calling up your bank, and instead of hearing the usual, "Your call is important to us, please hold," hearing, "Hey, Freddy, how are you doing? If you remember the rent's due this week," or perhaps more likely, "Hey, Freddy, looks like you overindulged at the weekend. I've set aside the rent before you blow the lot." There's been a huge buzz around what's called Robo Advice, which you'd assume was trying to build products like the ones I've just described. And sadly, what it actually means is providing advice to people with too much money that don't know how to invest it properly. But those same conversational interfaces could help the people with most financial needs. A recent report by Lloyd's contrasted digital access with financial capability, and it found a surprisingly high 19.6% of us, or over 12 million, have high digital access but low financial capability and could therefore really benefit from technology. And 87% of us are now online, and the vast majority of us use a smartphone. And perhaps what's more surprising, even those in the sort of 65 to 75 age group are now twice as likely to use a smartphone as they were in 2012. But even if we could talk to our bank, how does my bank know what's best for me? Banking needs to be relevant, and we need to make decisions based on concepts that we understand. Now, I always remember hearing the story of a lady not far from our office in London. She'd been working with a debt charity and struggling with debt for a long time, and finally overcome her troubles. And she actually wanted to start saving, so she walked into the local branch of her bank and sort of declared to the guy at the desk, "Hey, I want to open a savings account." And the chap said, usual options, you can get an ISA, it's £15,000, tax-free. Maybe you want to get a savings bond, £2,000. And this lady didn't do either of those things. Instead, she left the bank. And she was so embarrassed and ashamed because she only wanted to save £1 per week. And what use is a £15,000 ISA to someone who wants to save £1 a week? Banking needs to be relevant. But how can we get relevance without reciting our life story or every time we pick up the phone or go online? Well, prompted by a piece of EU legislation known as the Payment Services Directive, earlier this year, the Open Banking Working Group was formed between the Treasury and the Open Data Institute with the goal of building an open standard for access for financial data, our financial data. Or put more simply, it means that at the click of a button, I could go to any authorized company and say, "This is me, here's my financial story, what's the best deal you can give me?" Better still, it means that the products and services we use can be tailored to our exact requirements. I'm thinking a credit card that detects missed payments before they happen. Or how about a current account that recognizes when I've got money left over and invests it for me? Our banks make a huge amount of money by locking us in. They hook us with free current accounts, but then build walls around our data, making it harder for us to shop around for subsequent products. Open banking will be the key to knocking down those walls and creating competition and building products and services that meet our actual requirements, rather than the one-size-fits-all approach we're lumbered with today. So, do you remember Leon? Leon's a mechanic. He works hard during the week, he's careful to pay his bills on time, and even save a little. He doesn't have a credit score because he's never borrowed money, but he's facing a shortfall in the run-up to Christmas and needs some extra cash to pay for presents. Now, imagine if Leon could just explain all of this to his bank and get the answers he needs. Perhaps something like this. So, if our banks become robots, then maybe it's not such a bad thing, as long as we look after the Leons as well as the Henrys. Thank you.